Welcome to our webinar today titled Helping the Next Generation Buy Their First Home. My name is Tim Gaspar. I'm the Head of Lending here at FMD. A quick introduction about myself. I joined FMD a little over 12 months ago, having run my own finance business for over 20 years. What I love about finance is not the numbers or dealing with banks, but helping people achieve their goals, starting with first home buyers and growing from there. Today, I'm joined by David McMillan, who is the co-founder of Performance Property Advisory, and David is no stranger to FMD or our clients. He's a leading expert on property investment and advisory, with over 25 years of experience advising high net worth individuals, family offices and property professionals across Australia. Performance Property plays a pivotal role in shaping strategic investment solutions that drive long-term financial success. Now, a little bit of housekeeping before I hand over to David. If you have any questions along the way, we'd love to hear them. There's a Q&A button across the top. For some of you, you might find it under the More tab. Please drop your questions in there and we will answer them at the end of the presentations. Following this meeting, you'll receive an email from us with a survey and we'd love your feedback. But you'll also receive a recording of today's session and you'll be able to play it back later or share it with friends and family who you think might benefit from it. Now, there's the usual disclaimer and let me set the scene for today. Sentiment around property in Melbourne has been far from rosy. The promise of rate cuts in 2026 quickly turned into 3 rate rises. On top of that, we've seen the introduction of the increase of land taxes, the introduction of vacant property taxes, and changes to landlord and tenancy arrangements that have all added to the cost of owning investment properties. And all of that was before the May budget, which has seen changes to negative gearing and capital gains tax. So this has undoubtedly brought pain to many who own investment properties, but what represents pain also represents opportunity for others. David's going to talk to us through what he sees as the opportunities in Melbourne, why Melbourne is a particularly good market at the moment, and where those opportunities are and how they've come about. I'll then briefly touch on how families can help adult children get into the market. And on that note, I'm going to hand over to David.
Thank you, Tim. I'm just confirming from some of the attendees that you can see the slide deck that we've got on screen that says FMD Property Market Update. Can some of the attendees just let us know in the chat box? Here we go. That is a hand up from Angelina. Does that mean that you can see? They've got their hand up. I presume that means they can see. Jen, is there any way we can get them to confirm? Because I'm seeing 2 different screens here. I just want to make sure that we're not. I think
I'm getting some yeses from a number of people.
Awesome. Okay, cool. All right, well, thanks for the warm introduction, Tim. I really appreciate it. Today we're going to be talking about the property market and specifically Melbourne. I don't know why, Tim, but I can't change your screen now. Are you able to move through the slide deck for me?
Sure.
Apologies. Yeah. But before we begin, let's just let everyone know that this is general advice. This presentation is for general purposes only. If anyone would like some specific property advice, they would need to come in and see one of the advisors at Performance Property. Okay, so a little bit about us. We've been working with FMD for a very long time. I probably want to say 10 years, but it perhaps hasn't been that long, but it has been somewhere between 6, 7, 8, 9 years. We've got a lot of mutual clients and there's a lot of trust there. Our business has been going since 2013. We oversee about $4.5 billion of properties. That's us giving advice on whether to buy, hold, or sell. We focus on moderate to high income earners, and we've got 90 staff across the organisation. Thanks, Tim. So our business is primarily focused on, first and foremost, understanding how the market works. So we spend roughly about $1 million a year on research, and we've been doing that since inception. And of course, once you understand how the market works and once you're tracking it every month, then you can start to give good quality advice to all your stakeholders, obviously including clients. So once we've given advice, then we will buy for clients or we'll sell for clients. And once we've bought for clients, we will typically manage for clients. And the service that we offer is to meet with someone, understand their needs, work out the most appropriate next steps, and then have an ongoing relationship with them by way of an annual meeting. Thanks, Tim. Okay, so this is how the property market works. These are the various market stages. It's important because if you understand how the market works, then you can understand what to do. Even though if we take Melbourne, for example, the media is telling you not to buy, the media is telling you to sit on your hands, as is the government for that matter. And so where are we in the property clock? Like, is the market 5 years from today going to be double? Is the market 5 years from today going to be the same price, or is the market 5 years from today going to be 20% cheaper? So this clock enables us to forecast and give our various stakeholders the best estimate as to what we think is going to happen in the future. And if we look back through history, we've actually been fairly accurate. You're never going to be perfect with forecasting, but we've been fairly accurate in terms of the direction and a little bit less accurate in terms of the size, but we've been pretty good. And that's why we've got a lot of repeat clients that keep coming back. So if we look at this clock right now, and you had to, if you're in the audience and you're looking at all these various stages, it would be good for you to just think about where you think Melbourne is in the cycle, and therefore perhaps inform yourself as to, what you think the future is going to look like. Now, what I can say about Melbourne is we're definitely not at the peak. And the reason why I say that is because we're buying property in Melbourne cheaper than 2016, 2017, 2018. So we've had an 8-year stagnation. And during that stagnation, about 4 years ago, rents started rising. So if you were going to plot Melbourne somewhere on this clock, for us, it's very obvious. Melbourne has gone through a correction, peaked in 2018, or somewhere between 2016 and 2018. We don't really know yet. There was an oversupply at the time. Construction did slow. Values have stagnated. Development sites are unfeasible. Population has started absorbing the surplus supply. Vacancy rates have been coming down and rents have been rising. In fact, rents have been rising for 4 years in a row in a single digit capacity. And if you turn on the news any given day, the media sentiment is screaming at you loud and clear. Do not buy, do not do anything, sit on your hands, the property market is falling. Now, when that happens, of course, just because, we've had adverse tax reform and we've had rising interest rates doesn't mean that the people go away. In fact, we'll talk about the Melbourne population shortly, but one thing that's been lost in the media is that the headline population growth rate in Melbourne has never been stronger, and that needs to go somewhere. And if it's not going into the buying pool, of course, it's going into the renting pool. In fact, it's going into both, but a disproportion is showing up in the rental pool. So our real forecast at the moment, you'll see the clock, is Melbourne is actually at the bottom of the cycle. It is a great time to buy in Melbourne, despite the fact that you probably don't feel like buying in Melbourne. It is arguably the best time we've seen since 1996 to get into the Melbourne market. The indicators are screaming at us that loudly. What do we think is going to happen next? Rents will start to rise double digits, and the market will move through the clock. So as you can see, Melbourne is at the bottom, both for units, which is on the right, and for houses, which is on the left. And here you can see every other market around the country and where we think it is based on those frameworks that we showed on the previous slide. So if you go to and we can come back to this in question time, depending on the the questions that we receive. But if we flick off to the next slide, a different way that we show our clients a different way to interpret the market is just to look at how much forecast runway there is in every market. So how far can a market grow, and how much demand is in a market. So on the left axis there is demand, how much demand is in a market, and on the right axis it's how much runway is in a market. So what we're saying is, nationally, Gladstone houses have probably the most to grow across the country, and nationally, Brisbane houses are the most in-demand product out there. And you can see where Melbourne sits. Demand does exceed supply, and there is runway, but there are better markets to consider if all you had to consider was, I want to find the investment. This is for houses. Tim, if we can go to units, which is the next graph, you can clearly see that units have far more potential runway and also are in far more demand than houses. And the reason for that is because when prices become unaffordable through rising interest rates, which is what's been happening, the lower quartile is where all the demand goes, because everyone's affordability is reduced, and therefore everyone focuses in on the 25 percentile, which is the affordable end of the market. Everyone's budgets go down through borrowing capacity, through budget constraints, and therefore the focus shifts to units, which is what we're seeing. So we're seeing units more in demand during this phase of the cycle, and we're seeing units have a much higher potential for growth. In Melbourne's case, we're forecasting 80% growth in units over the next sort of 6 to 8 years, and we're forecasting 50% growth in rents. So let's look at Melbourne and break it down graph by graph. Some of these we'll flick through. The most important thing is the framework for how you think about a market. So what we want to see clearly is demand exceeding supply. How do you know if demand is exceeding supply? All you need to do is look at rents. If rents are rising, demand exceeds supply, because rents don't rise for fun. Rents rise because tenants compete against each other. And that is your most accurate indicator. And as you'll see, rents have been rising in Melbourne for 4 or 5 years in a row. The next one is, does the market show value? Value is, there's many different ways to measure value. There's discount to replacement cost, affordability index, and gross yield. All of those indicators right now are flashing green for Melbourne. And the last one is confidence. So these are the 3 things that we look at before we enter the market. Funnily enough, the right framework for confidence is we want confidence to be negative. Okay, because if confidence is negative, what that means is when you show up on auction day, you're the only one there, which is a good thing, because you then have the right negotiation framework to buy that property as cheap as possible. What most people want to see before they enter the market is they want to see broad-based support from the media and dinner parties and everyone they talk to before they feel confident to go market. The way we try and educate our clients is, all you need to see is demand exceeding supply. You need to identify that the market shows value, and preferably massive value, and you want confidence to be negative, which is really where Melbourne is right now, which is why we're advocating our investors get into that market. So next slide. Thanks, Tim. We'll just go into a bit more detail on these 3 things, and then we can open up for questions time. So demand. Okay, so the forecasted population growth is 267,000 people over the next 3 years. And in all the negative commentary floating around with the media, no one's talking about the fact that Melbourne's experiencing record population growth right now, and it is experiencing record population growth. If you go to the next slide, Tim, you'll see why. And the reason why is because we've stopped losing our interstate migration. Obviously, after COVID, a lot of people left for different reasons, but one of the main reasons was, the state government was pretty restrictive with how they handled the COVID crisis. So many people left, and you can see the grey bars there, which is people leaving the state of Victoria. And that has since stabilised. And the reason why it's stabilised is because in 2020, you could go sell your house in Melbourne, cash in, let's say you had a $2 million house, you could sell it, go to the Gold Coast, buy something for 1.2 million and cash in 800,000. Now, for the privilege of going to the Gold Coast, You sell your house, the same house for 1.8 million in Melbourne, and the same house in the Gold Coast is 2.2. So you have to spend an extra 400,000 to move to the Gold Coast. So the affordability relationship between Melbourne and everywhere else, as you'll see in further slides, has changed, has flipped on its head. And there's no longer an opportunity to leave Melbourne, buy another property and get change. In fact, the reverse is true. And so in many ways, people are trapped. They're sort of stuck here financially to stay in Melbourne because they can't release some equity by moving to a different state. Next one, Tim. Okay, so this is the rental story. Does demand exceed supply? Yes, it does. How do we know this for sure? Because rents are going up. Very straightforward. Vacancy rates have been coming down since 2020 and rents have been going up. So we know demand exceeds supply. In addition to that, we're not building enough. So the forecasted vacancy rate is to go lower. This is total dwelling approvals, commencements. The forecasted vacancy rate is set to go lower. And as I mentioned in the original property clock slide, we are now forecasting rents to go moderate. So what that means is somewhere between 8 to 15% rental growth year on year until such time as developers build more stock. Next slide. In addition to developers not building enough stock, the state government is actively chasing landlords out of Victoria. And this graph is unique to Victoria, and this graph shows something that's actually never happened before. And that is there is less rental properties in Victoria now than there was 4 years ago. Why? Because the Victorian state government has put in a bunch of onerous conditions with regards to our rental laws, and Victoria rather, is the most expensive state to run an investment property. And therefore, a lot of investors have said, it's too hard, I'm selling. Those properties have not sold to investors. Those properties have sold to owner-occupiers, right? So this is the bond lodgements that are held with the Victorian Authority. There's less bond lodgements now than there was 4 years ago, which tells you there's less rental properties now than there was 4 years ago. That has never happened anywhere in Australia since the records began. And it is significant because what it means for rents is rents can only go up on a rising population base, and rents are likely to go up double digits. Thanks, Tim. Value. Okay, so we now for sure know that demand exceeds supply. There is no question in our minds. Demand exceeds supply and is forecasted to exceed supply for the next 3 years. So you have those tailwinds. And right now, when you don't feel like buying, it's so important to understand and acknowledge that. The second most important step is, does the market show value? Now you can see Melbourne has been broadly stagnating since 2018, 2019. But I can tell you in practice, we've been buying properties in the last month, some as cheap as 2014. So think about that. We are buying properties at the moment. We have bought a property last week cheaper than 12 years ago. Now, we never thought that we would see these conditions in Melbourne. These are conditions that exist in places like Perth and Townsville and Darwin and all these other highly volatile markets. So to see these conditions in Melbourne, to see this stagnation, broad-based stagnation, is pretty significant. And for us, considering demand exceeds supply, it's a buying slide. We're looking at this saying Melbourne does show value. Let's get in as quickly as we can. Next slide, please, Tim. We're also seeing units show more value than houses. So our focus at the moment for investment is units. It's not to say that houses won't do well, because I think houses will do well. It is to say that units will probably be better, will do better. And our business focuses on buying something for 600 and selling it for 1.2. That's what we've been doing for the last 13 years. That's what the business does. We think that opportunity exists more in units than it does for houses. Thanks, mate. This is just an example to show you how affordable Melbourne is. This is the price to income ratio in Melbourne versus Sydney. You can see Melbourne is in the black for houses, for units rather. Melbourne's in the blue for for houses, and you can see that there hasn't been much change to the price to income ratio since 2010. So it's been fairly flat for 16 years. And then you look at the yellow line there, which is the house price to income ratio in Sydney. And so Sydney's gone from a house price to income ratio in 2010 of 9 all the way up to almost 15, whereas Melbourne's been flat. So it does show you that Melbourne represents value. This is not isolated though. We can show you this to other markets, and this trend exists. Next one, please, Tim. Okay, this is the gross yield versus the variable rate. Now, the most important thing to focus on here is the grey line. So what that grey line says there is gross yields are about on units is about to hit 5%. Now, the last time gross yields on units hit 5% in Melbourne was in the year 2001, right? This is a significant event, and the reason why this is a significant event is because the average interest rate over the last 20 years is 5%. So we are of the view that when interest rates normalize, it will be cheaper to buy an apartment in Melbourne interest only than it will be to rent an apartment, which has always been the catalyst for every market that we've been in to go on really aggressive price runs. So we can see those conditions forming right now. Whilst we're not forecasting interest rates, what we are saying is this black line there, which is the interest rate, at some point in the next 36 months, will go below the yield, that grey line there. And when it does, it's off to the races for the Melbourne market. And we're conditioning our clients right now to buy as much stuff in the Melbourne market as we can. And we're at the moment, because sentiment is down, we're buying about 40 properties a month. I'd love to be buying about 100. It's just hard to get our clients to move. This is Melbourne, showing Melbourne yields by comparison to other capital cities. It's showing usually Melbourne and Sydney sit much lower than this. Usually Sydney and Melbourne are 100 to 200 basis points against these other markets. And you can see markets like Adelaide and you can see markets like Brisbane have lower yields than Melbourne, which doesn't usually exist. In fact, Adelaide, as an aggregate median price, is more expensive than Melbourne. And the last time that happened was 1984. So it is an anomaly what's happening in Melbourne right now, and another value point. Next one, Tim, please. And this is Melbourne's relationship to Sydney. So as you can see, the long-term relationship to Melbourne and Sydney is usually 73%. So usually Melbourne sits, 73% of the Sydney house price. And at the moment, it's down at about just a touch over 55. This relationship since the data began has never been lower. So what does that mean? If you're coming from overseas and you're thinking about coming into Melbourne or Sydney, unless you had to go to Sydney for your job, you're probably coming to Melbourne. What does it mean for people living in Sydney? Mortgages are incredibly expensive up there. And because Melbourne is the second best place to get a high-paying job, then there'll be some interstate migration, and we're already forecasting that in our models at the moment. So this is a clear value indicator for Melbourne, but one of many value indicators for Melbourne. The last one is that Melbourne is usually, if you go back to the last decade, sat between the second and third most expensive city. On average, long-term average, it's the sixth most expensive city, and now it's the 12th most expensive city. So clearly, another value indicator. Tim, I think we'll go to the next slide. So this is the last slide for value, and what this shows you is what it costs to build a medium density apartment versus what it costs to buy a low density apartment. So think about a low density apartment. You go to Hawthorne, Camberwell, Armidale, St Kilda, Elwood, doesn't really matter. You're buying in a block of 6 or a block of 8 or a block of 10. You're buying a brick property built in the 60s with a garage, typically much larger than what they're building today, typically much better than what they're building today. The product these days is medium density, 20, 30 stories high, which is the only comparable product because no one builds like they built back in the day. We're buying the existing product just take the middle ring example, example, at 8,000 a square metre, but it costs $12,000 a square metre to produce. Now, what does it actually mean? It means that developers won't be able to build anything. That's what it means primarily. Developers won't build any product in Melbourne right now because it's not feasible to do so. Developers won't be able to get money from the bank to build these properties. The only developers building at the moment are cash developers. So developers that don't need funding, which is the minority, or it's developers that are building prestige downsizer stock. No one is putting any meaningful bedroom production into Melbourne, as evidenced by that graph I showed earlier, which means that these tailwinds of population coming in, but no supply getting built, are locked in for the foreseeable future. And we would argue that they're locked in until prices on existing stock move 60 to 70%, 50, 60, 70%. That's what needs to happen for dwelling production or bedroom production to happen. And so these are the exact conditions that we're looking for to go into a market enthusiastically. Next one. So we do some sensitivity analysis depending on where their interest rate ends up. And obviously interest rates have a big impact on where prices can go because it sets the affordability. So the long-term interest rate, as we sort of mentioned before, is about 4.95. That's a cash rate of 2.66 with a margin. So we think houses in Melbourne could run 50% if interest rates normalise. And if you go to units, we're looking at the red here. We think units, when interest rates normalise, could run 80%, which we think is a highly probable outcome from a growth perspective. And lastly, let's just touch on confidence. So we can sort of flick through these slides here, Tim. So job ads are down. Business finance is, arguably in the last sort of 12 months is trending sideways or down. This is in Victoria, by the way. Housing finance is down. Consumer confidence is down. House price expectations are down. Business confidence is down. And we're looking at underutilization here just as a cross-check to see if there's a larger underemployment problem, which isn't the case. But as you can see, the mood is clearly negative, and people will argue that that's a bad thing, but it's actually a good thing in the right market. Okay, so with respect to Sydney, the Sydney market is incredibly expensive at the moment. It's toppy. It needs to come off a bit. It needs to have some price reduction, and even after it has price reduction, it's probably going to go sideways. Melbourne is just not at a comparable point. Melbourne has been down for a long period of time. Demand definitely exceeds supply. No one's building stock. Confidence is down, and that is the reason to get in, is because when you show up on auction day, no one's there. And as long as you have a 6 to 9 year view on that property and your personal circumstances permit, you going into that investment and you've got job security and a bit of a cash buffer, this is exactly the time to either invest in this market, and I know this is tailored at first home buyers, or to get your foothold into the market. I'll leave it there, Tim.
Thank you, David. I'm sure there'll be lots of questions about what you've run us through, and clearly for first home buyers who are likely to be looking at apartments or units, you've built a strong case as to why they should be looking to act sooner rather than later. Moving on to what I wanted to talk about. So I wanted to talk about how families can help first home buyers get into the market. And there are 4 areas I believe that families can make a big impact, or ways in which they can make a big impact. And the first one is education. And I know mostly people think about helping first home buyers in some sort of financial sense, but education is just as vital, and today is a great starting point for that. And I encourage FMD clients who have adult children looking to get into the market, or who will be facing that in the next 5 years, to get on the front foot and to engage with the advisors here and with the lending team and help these first home buyers to get a strong grip on their financial position, develop a plan of attack, so that when they're ready to make that move, they're both educated and financially in a position to do that. Looking now at the next one on that list, and that is family guarantee, and I'll look at lending and gifting after that, first of all, what is a family guarantee? Well, a guarantee is where a parent offers a property of theirs as a second security alongside the property that the first home buyer is buying. And the value in doing that is that the first home buyer needs less savings or funds to be able to make the purchase. And they need less funds because we're using the equity in the parent's property to support the loan. It's a great avenue for families that are asset rich and cash poor. And the benefit for the first home buyer is that they can obviously get into the market with less savings. They can potentially borrow 100% of the purchase price and costs, but equally they can avoid mortgage insurance, which can run up to $40,000 or $50,000 as a one-off cost. Now, with every positive, there are some downsides to be aware of. Firstly, this option, for all its strengths, won't help a first home buyer if their income isn't enough to support the loan that they're looking for. The cure is for the lack of savings. The next thing to be aware of is that by providing a property as a second security, the parents are putting at risk their property, and they need to understand that and consider that carefully. And associated with that is that any relationship breakdown, whether that be your relationship between a parent and child, or indeed if you're helping a child, between that child and any partner they may have, it does make the family guarantee situation a little bit trickier to unwind. So now I wanted to take you through an example of that. Jack and Diane came to us. They were looking to buy their first home. They had two strong incomes. They had $150,000 in savings and a HECS debt. When we ran the numbers for them, they could borrow about $1.15 million, which meant they could buy a place for a bit over $1.2 million. Now, there were a couple of issues with this. One is the mortgage insurance was going to cost them over $50,000. The second part was, even in this situation, they couldn't buy what they were hoping to buy. They didn't have enough income or savings to get them to their desired purchase price. So we sat down and looked at what the solutions may be. And there were two levers that we could pull that would help them get into their first home. Firstly, we decided that we would use some of their savings to pay off their HECS debt. You'll recall they had about $100,000 in HECS, and when they used their savings to pay that off, that increased their borrowing power by almost $300,000. So there was real value in doing that. Obviously, now their savings was down to $50,000, and that was the next barrier. But with the help of the parents, we could get around this. The parents who had provided a family guarantee before for another child of theirs was prepared to put their home up as a security for the loan. And there was enough equity in their home to do that. And that meant that we now had a solution, and this is the way that it looked. Now the first home buyers could borrow up to $1.4 million, which meant that they could, with the $50,000 in savings they had, buy a home for a bit over 1.3 or around 1.36 million. Now, the key thing to understand for most people is how this is structured and what it means in terms of a family guarantee. The first 80% of the value of the first home buyer's home is secured against the first home buyer's home. And only the lending that is above that, which in this case was $312,000, is secured against a combination of the first home buyer's home and the parent's home. So that is the extent of the exposure of the parents. This solution obviously had a number of wins. Firstly, it got the first home buyers into a property at the price range they were aiming for. Secondly, they were able to avoid $50,000 in mortgage insurance. And what's the long-term plan? The long-term plan will be to release the guarantee as soon as possible, which can be done through a combination of paying down the loan and seeing the property value increase, so that lending then sits under 80%. Now, moving on to the other avenues for parents to help first home buyers. The next one is by lending money to the first home buyers. The strength of this as an option is that you don't need to put property up as and expose it as you don't need to put property up into the transaction, so it limits the risk. You can retain control, and it is money that is going to come back to you under the terms of the loan. Obviously, you should document the arrangements very clearly, both from the point of view of making sure that parents and first home buyers understand what the terms are, but equally where you are helping a child and they have a partner and that relationship breaks down later, it should be clear that the money provided was a loan and not a gift. It will be relevant to sorting out the financial affairs of the children at that point in time. So the next option is helping by gifting money. Now, this is the simplest of the options, and it doesn't impact the first home buyer's borrowing capacity as a loan might. But obviously, you need to be able to afford to do this. And depending on your position, there may be implications for Centrelink entitlements. And equally, what you do for one child, you may be expected to do for other children. And do you have the means to do that? If you are lending money to a child and they have a partner and that relationship breaks apart, it is also important to understand that any money you've gifted to them in the course of buying a home will be treated most likely as part of their joint assets and divided up. So you may want to consider whether you wanted to gift money to your child's partner. So they're the four main ways of helping first home buyers. And I've got a section here which I'm only going to touch on very lightly, but in addition to parents helping first home buyers, there is government assistance available in a number of different forms. That assistance can sit side by side with parental assistance. It doesn't have to be one or the other. And that assistance does vary state to state. We will be sharing a white paper out of today around my slides, and in that we will contain links to websites that will give you more information about each of these programs. But equally, there's a QR code, and if you'd like to book a time to have a chat with me around finance for first home buyers, please feel free to scan that code and to book in a time to have a chat with me. We'd be more than happy to talk you through how all of the government programs work.